Well, thank you very much, everyone, for joining us today for this federal budget review and investment update. Before I start, let me cover off the formalities and remind you all that this is general advice, and in our conversation today, we won't have taken your personal needs into consideration. And of course, if you have any questions coming from this seminar, please speak to your advisor. We'll also be able to take some questions today. So in the Q&A box on your screen, just type them in and I will try and direct them to the correct person at the right time. And if we can't get to your question in the session today, I'll certainly make sure that we get back to you afterwards. So thank you very much for your contributions. As I always say, I'm not very technical when it comes to Zoom. So if you're having trouble with Zoom, the best advice I've got for you is to turn off your browser and start again if you have trouble through the seminar. But I hope you follow us all the way through. Well, our panelists today are Jason Collegia, who will be addressing the budget implications. And as always, for the portfolio and market implications, I have Mike Reynolds, who's the Director of FMD Financial and Investment Committee member, and Richard Dahl, who is the Chair of the FMD Investment Committee. But Jason, let me start with you. Tell me, what did you think of this budget?
Yeah, thanks, Lee. The recent budget, it was more like a mid-year economic and fiscal outlook. Minimal changes really impacting on our clients. However, what is clear is the next budget's likely to will have some key policy and reform budget in there.
Great. So can you just run us through some of the things that we did learn through this budget?
Yeah, so in saying that, there's some changes which are worth noting around superannuation, tax, social security, home ownership and affordability, and families and aged care, which I'll touch on. I've got a few slides which we'll run through and dig a bit deeper on each of those. Great.
Well, do you want to start with, where do you want to start? Superannuation?
Superannuation, Lee. If you flick over to that slide there. So in terms of the superannuation changes which are worth noting, one of the key ones is the downsize of super contributions. So they've reduced the age on your eligibility from age 60 to age 55. So what that means is a lot more people will be eligible to make that those contributions. This measure's effect, it's expected to take effect from the first quarter after passing into law, which we expect will be about 1 Jan 2023. And there's a bit of a refresher around the downsize of contribution. So it allows people to make a one-off post-tax contribution to their superannuation of up to 300,000 per person from the proceeds of selling their home. And look, there are some conditions you need to meet, like having owned the home for at least 10 years. But assuming you do meet those conditions, both members of a couple can contribute that 300,000 each, so 600,000 in total. And it goes in and doesn't impact the new normal non-concessional caps. So quite attractive if you can take advantage of that one.
Yeah, it's a really good one, Jason. And if you are selling, even if it might be a holiday house and you've owned it for some time, it's definitely worth talking to your advisor about what might be worth.
Yeah, I've touched on this in some previous webinars, but you just have to have it as your primary residence. It could be for a year, and then it's been an investment property outside of that and still eligible. So definitely worth speaking to your advisor around. Thanks, Lee.
Thanks, Jason.
Some other changes are around share buybacks. So the government announced that the tax treatment for off-market share buybacks for listed companies will be treated in the same way as on-market share buybacks. So if you think back, for those of you that remember, so BHP and RIA are some companies that have undertaken off-market buybacks. So what they do is they essentially offer you a lower price than what the current share price is on the market and use franking credits to then provide an overall higher price. And it's mainly attractive for low or no tax paying entities such as superannuation pension accounts. So once you get your franking credit refund and the proceeds from the company, it's higher than the current share price. So look, it's been a bit of a free kick for a while there, which we've participated for clients, but it's going to stop essentially. And this is expected to save the budget around 550 million over the next 3 years. I do want to just touch.
Impacted as well.
No, it isn't. But I do want to touch on, there's a bit of confusion around, you hear franking credits, and some, I know some people have contacted me and checking whether that impacts on their normal franking credits from their dividends. This is very separate to that. I know there was a previous sort of contentious, let's call it, proposal in a previous election, which caused a bit of a stir, but this is very separate to that at this stage. On the personal income tax side of things, so not a lot of changes here, but the things worth noting is the low and middle income tax offset, which was in play for the last few financial years, and was really designed to take some pressure off during COVID and prior to that. That's ceased essentially from 30 June 2022, so no longer eligible or applicable for this year onwards. So it's mainly going to impact on individuals earning between 37,000 to 126,000. And I've got a slide there, which I'll run through in a second. And then also the tax savings from the stage 3 tax cuts, which again, that was from the previous government that had put them in place. There was some talk around at the budget whether they were going to be impacted. In the end, they haven't made any change to that. They are due to come into play from 1 July 2024, though, so still a few budgets to go. And I wouldn't be surprised if we see the government tinkering with those. But at a high level, this table shows that for the low and middle income tax offset, it's really going to be impact on those earning 40,000 to 120,000. So compared to last financial year's tax return, there'll be a little bit of extra tax payable there. And then the tax savings that you can see on the far right column, the main benefit is really those earning 120,000 and above. You'll see some significant tax cuts, assuming that none of those, proposals are changed. So it is quite generous at that end of the market. So we'll have to wait another couple of years to see if anything changes there. But assuming it stays the same, yeah, quite significant tax savings.
Thanks, Jason. What else can you share with us from this budget?
On the social policy support side of things, there were a few announcements there worth noting. So for Social Security, reducing the assessment of home sale proceeds. So if you think about aged pensioners, that currently if you sell your home, okay, the settling gives you 12 months, assuming that you're going to go buy another home where they won't assess it as an asset, the proceeds as an asset. They will deem it for income test purposes. But the two things that they're looking at doing is extending it from 12 months to 24 months, so giving you a bit more time to go and find that new home, and deeming it at the lower rate of 0.25% rather than the rate of 2.25%. So in summary, it would allow people that are age pensioners that are selling their home and looking to buy another home, their age pension payments won't be impacted as much during that, call it 24-month period while they're searching. There's also some changes around cheaper medicine. So the government's committed to reduce the cost of the general co-payment on the pharmaceutical benefit scheme from $42.50 to $30 per script. That's from 1 Jan 2023. But probably the big one out of this budget on the Social Security side is the Commonwealth Seniors Healthcare Card. So it had been talked about for a while by both parties up to the election. And essentially, the government's increased the income threshold for the Commonwealth Seniors Healthcare Card from about 61,000 to 90,000 for singles, and from 98,000 to 144,000 combined for couples effective the 4th of November. So it's in play now. For those of you that aren't familiar with the Commonwealth Seniors Healthcare Card, it provides cheaper medicine under the pharmaceutical benefit scheme. For some, there's some bulk bill doctor visits, assuming that your doctor is eligible for that. There's also economic support payments, so some government handouts from time to time. So some of you might recall through COVID, there was a few payments ranging from about $250 to $750. There's about 3 or 4 payments there. And then a big one is for our Victorian clients, the potential stamp duty savings on the purchase of a home. So if you think about a retiree that's downsizing, so they've sold their home and is ready to buy another home, if they have the Commonwealth Seniors Healthcare Card, as a couple, you can get concessions on stamp duty for a property up to 1.5 million. And as a single, up to 750,000. So it is a pretty big benefit there, and one worth noting. So if you are in that sort of range of thinking about selling and buying a property in the next sort of 6 to 12 months, please reach out to your advisor. Otherwise, I'd encourage you to just have a chat with your advisor at your next review meeting, and they can crunch the numbers around your eligibility there. A few more minor changes on the Social Security side of things. So deeming rates, so that's what they essentially use when looking at partly the Commonwealth Seniors Healthcare Card, but mainly the age pension, is the government's agreed to freeze the current rates up until 30 June 2024. So usually when interest rates are increasing, those deeming rates will be going up too, but the government's essentially freezing that to take some pressure off retirees. Another one that they're looking at doing is around the work bonus. So for those that are receiving the age pension and maybe doing a little bit of work or want to do some work, they're trying to encourage I guess, the ability to go back into the workforce and do some hours. So that'll take some pressure off sort of the shortages at the moment. And essentially what they're doing is providing an extra 4,000 credits to the work bonus income bank for the 2022-23 financial year. So currently it's about 7,800, the work bank, and it's going up to 11,800 before the age pension's reduced there. So a small thing, but hopefully that takes some pressure.
Yeah, it's a pretty complex system, Joe, but basically means my dad can do a few more hours at Bunnings now. Yeah, exactly
right. Tell him he can go put the application in or get a few extra hours there. All right. There are some other areas I just want to touch on, which is paid parental leave. So from 1 July 2023, the government's essentially proposing to open up to fathers and partners. So having a combined scheme of up to 26 weeks, which can be shared between eligible partners there. So that's a positive thing. The childcare subsidy changes there, but I won't go into that today, given it is quite complex. And then on the aged care reform side of things, so this is always a topical one at budget time. So I think it's just fair to say there's lots of aged care reform on the radar, and it's going to take some time to roll it out, but nothing specific at this stage worth sharing. On the positive side of things, home care packages. So clearly a lot of people would prefer to stay in their home and receive care rather than going into residential aged care. So the previous government had announced an extra 80,000 home care packages. And also this budget includes measures that attempt to improve the home care services by introducing price caps on the administration and management fees, and also removing exit fees charged by providers. So really the key parts there are worth noting. Then finally, Lee, I'll leave you on this one, which is the national, I guess, the housing ownership and affordability. So in an effort to assist more people into home ownership, which is always very topical for government, they've announced the National Housing Accord, which brings the government, institutional investors, including super funds and the construction sector together to try and deliver 1 million affordable, well-located homes over 5 years from 2024.
Thanks, Jason. So I think, Labor governments typically love the concept of an accord. Go back to the Hawke government. I'm not sure this one's going to be as effective, but we'll see if that it does have an impact on housing over the coming years, because it's certainly, affordability is an issue that's going to be around for some time. Well, Jason, thank you for your contribution on the budget. Please hang around, and we may have some questions as we go through. But perhaps now I move to the market and portfolio implications, and welcome formally Richard and Mike. Thank you again for your time today. Mike, I might start with you. What have we learned from the budget about Australia's economy?
Well, broadly, Lee, I think the economy's in reasonable shape. The new Treasurer, Jim Chalmers, made his mark in his first budget by warning the public around the pressures of inflation. It's a bit of an unusual scenario where we have very tight labour markets, and the ability to attract people to jobs has seen modest wage pressure, but that's clearly something that central banks or reserve banks worry about. But inflation and interest rates from central banks is really the key unknown driving sort of the fears in the economy and investment markets. On the government's budget side of things, their revenue from both tax collection and then also royalties from coal and iron ore have seen a bit of a windfall with higher iron and coal prices, and the budget benefited from that. And then on the negative side is that as interest rates have pushed rapidly higher, the cost of government servicing their ever-increasing balance sheet becomes a bit of a headwind for their capacity to meet all their spending agendas. So it's a tricky time to be, one, an economist, two, a central bank, and that also gives some challenges for our investment committee in terms of navigating the issues that are at hand.
Yeah, thanks, Mike. It is a tricky time, certainly, and it's going to be an interesting one. And as Jason said, I think that the government was really setting up you know, it's got some positives, got some negatives, but really setting up for the next budget for what where the heavy lifting will to start.
In April next year, I think will be the real key.
Yeah. So Richard, I might come to you and ask you a pretty tough question, really. If I look back at the markets over the last 6 to 12 months, it's probably been one of the most difficult periods in my working career. Can you talk us through what's happened in that period?
Certainly, Lee. And yeah, this has been a difficult period. For many of us have been working in financial markets for 20 plus years. Look at the main components of our clients' portfolios are shares or equities, and the defensive assets and bonds make up those a fair component of that, Lee. And we'll have a look at this chart in a minute, just going to that. And if clients have been sitting with their advisors and having reviews this year, they certainly see that most portfolios are negative returns year on year. And well, it is unprecedented, because the two components of the portfolios, the bonds and equities, generally what you will do is that when we have periods when share markets retreat, look at 2008 there on the down the bottom right quadrant there. So share market was down heavily in that year, but the bond market, that's the things like government bonds and company bonds, they provide some cushion in periods like that. So we see that yellow, those yellow dots where bonds have delivered positive returns, or otherwise in the top right quadrant, many other years when they've both delivered positive returns together. We move over to that red dot in the bottom left quadrant, and we see that both global equities and bonds were more than 10% down to August this year. And you'll see that just has not happened in past years at all. So it is an unprecedented outcome, and it means that all portfolios, there's really no place to hide. And it's an unprecedented period, Lee.
And so, Richard, what's the one thing that's been driving this negative ratings of both equities and bonds?
Yes, look, if we think about the environment we're in coming out of COVID, where interest rates continue to be decreased by central banks, the Federal Reserve in the US and the Reserve Bank here and all other central banks, all our clients would know that their cash rates were negligible, not returning anything much at all. And bond returns as well were so less than 1%. Expectation was that, yes, that interest rates would rise at some stage, but the rhetoric from central banks was that was some way off. And this chart, really, if we look, what this shows is on the left-hand axis there, this is the cash rate in America, what they call the US federal fund rate. And we look at it on the bottom there, we'll see that through 2021, as I said before, it was barely above zero, that US cash rate or the US federal funds rate. And what we've got here is three other lines in January, June, and October, when the US Federal Reserve, the expectations of the trajectory of forward interest rates in future years, what would happen. And you can see that in January this year, the expectation was that interest rates would lift, but it'd be pretty gradual. And right out to 2024, they were predicting sort of 1.5%. In that sort of trajectory, you do get you don't get so much volatility in bond markets. Yes, the yields will rise higher, but what actually happened, we all know that interest rates started rising at the start of the year. Then we had the Russia-Ukraine crisis, and inflation came in, and all of a sudden the central banks had to try to stomp on inflation. How do they do that? They increase interest rates. And the bond market was the, if you like, the signalling as what's going to happen to interest rates. And now we see in June and October, the expectation of future interest rates is now 3.5%, 4%, Lee. And so we've had a massive adjustment, and that means all the other valuations of bonds and equities have been repriced. So markets just didn't anticipate this happening.
Great. Thanks for explaining that, Richard. So, Mike, if I come to you, we've been in a significant retreat across most asset classes. What happens next?
If I knew that answer exactly, Lee, it'd be a very simple exercise, wouldn't it? So, look, typically when you have big negative drawdowns in markets, it's normally followed by a recovery. And our view is that is still a likely outcome, but it's not going to happen until we get a change in message from central banks. And Jerome Powell, the chairman of the US Fed, is the person in charge of driving the bus effectively. So he is, until he makes a firm statement that they're done with raising interest rates, and we reach what's called that neutral interest rate, where rates don't go higher or they don't get cut. That's the part where we're really getting towards, or what the market is looking for, that will give us some stability back in markets. And I'm not quite sure where that's at yet. If you look at mathematically, is that if prices for goods and services don't move very much from this point, the end of March next year should see inflationary numbers start to come off. And because the conflict in Europe started in sort of the beginning of January, oil and energy prices spiked aggressively in that first quarter. And so at the end of March, you'll have high prices already locked in as a high figure. And if rates effectively don't change or prices don't move very much, you'll have a high number going to a lower number. And that's the point where inflationary pressures should ease. So we think March next year is likely to be the case. Our conversations that we had in these updates earlier in the year, were probably more on the side that things would be done by this time of the year, and that clearly hasn't happened. And that chart that you had up before was clearly shown those interest rate expectations rise consistently during the year. So I think the market is priced in most of those things. And the inverted yield curve, which means that short-term interest rates in the US are higher than longer-dated interest rates in the US, is a sort of a leading indicator that we're perhaps getting towards the end of the interest rate cycle. And markets have got basically two rates priced in from there.
Yeah. So, Mike, we're sort of, I guess what you're saying there is we're quite dependent still on what the Fed does, and even Australia is really dependent on the Fed as much as what Australians do. But what about the health of the companies that we're actually investing in? What do you think about those at the moment?
I think earnings in the US and here to some degree have been reasonably buoyant. Clearly the shortage of labour, and we actually saw this today from Westpac's announcement. So Westpac announced this morning a narrowing of interest rate margins, which was against the market, and their share price is down 3% or 3% for nearly 4% for the day. So their headline comments were price pressures on wages, shortage of labour, and all those sorts of contributing difficulties to their expense side of things puts pressure on margins. There is a degree of companies in the marketplace that will have the capacity to pass on price increases. But when you have higher energy costs, higher electricity prices, higher transport costs, shortages of materials for the building sector, shortage of supply chains, still because China's got lockdown policies, those price headwinds are going to put some pressure on the earnings for companies going forward. The market, you remember, is very forward-looking. We've talked about this lots of times. A lot of those expectations are already priced into share markets, and that's why our markets are down, double-digit returns here and 20% in the US. So if we get an ending to the interest rate tightening cycle and earnings numbers end up being okay, then markets are in a position where a lot of the negativity is priced in and they can build a recovery from that point.
Great. Thanks, Mike. That's a really helpful summary of that situation. Richard, I might, in the small amount of time we've got left, I might get you to just cover off on a bit of the portfolio positioning for the AMS portfolios that the investment committee's been undertaking in recent times, and just let us know where you see what's happening next there as well, please.
Okay, we'll just have a bit of a look back on we were just talking about bonds before, and diversification is always so important. We say it all over and over, diversify. Well, in those defensive assets for our clients, we're always looking at the risk management. We talked about bonds falling in value. Well, what we did last year, clients may recall, we communicated to say our exposure to government bonds, low returns, and the risk that interest rates would rise, we reduced our exposure to government bonds. How do we get our returns? We get it through corporate bonds, longer dated bonds, and diversification. So that's really helped us this year. That's the good news story. Obviously, the share markets, like Mike was talking about, have outweighed that. But we set ourselves in a good position, because what we've also done is increase those government bonds into the portfolios more recently. And back in 2 years ago, we were struggling to get 2% or thereabouts from the defensive assets. It's looking more like 3 to 4%, and that's quite significant in portfolios. So there's a better balance. The other things we've done is more recently is everyone's aware that the US dollar in periods like this becomes the currency of choice, and so everything else is weakened against, including the Australian dollar. So what we do is that down at 62 cents, Aussie dollar fell down to. On that trajectory on the way down, we increased our hedging. So what does that do? If we get some normalisation of markets and other currencies, including Australian dollar, rise, we protect our returns. We've done that. But look, overall, we've got quality assets in our Australian international shares. We remain fully invested in those assets, Lee. So like Mike talked about, there should be a rebound in the future, and the portfolios are well set for that.
Great. Well, that's a really good place to, I think, wrap this up in terms of that. That rebound will come, and it's good to know that we're well positioned with that, as well as the hedging. I think it's a really valuable addition to that. Look, can I wrap up just by thanking each of our panelists, and if I just do what I'm supposed to do here and re-show that the general disclaimer, just reminding you that if anything that we did discuss today you might be thinking is applicable to you, please speak to your advisor before you act on it. Thank you very much, Jason, for your insightful presentation on the budget. Thank you, Richard Dahl, for your contribution on the portfolio positioning, for you, Mike, particularly for your interest rate insights. We do think you're the guru on those things here, and it's always great to get your perspective. So on that basis, I also thank everyone for joining us today. We'll circulate this video in one of our regular updates as well. So if there's something you want to go back to, you'll be able to catch that on video. Thank you all for joining me, and have a great afternoon.